you are trying to get educated and put the best portfolio in place that you can. Looking in the rearview mirror and saying we should have done this is easy. Everybody's vision is 2020 looking backwards. Okay, so just make sure that you are prepared for what's ahead, and then as it comes, do not get emotional with your investing. Okay, that is the number one killer, in my opinion, of portfolios is emotions. My name is Jamin Garabedian with Assurance Wealth Management. I want to welcome you to our monthly investor education webinar. If you've been to one of these before, you'll typically see that we have somebody else on here, another specialist on a certain topic, and it's more of an interview style where I'll be asking them questions that I hear a lot from our clients, and they answer it, because it is their specialty. Today, because it's on investing in today's environment, and I am the Chief Investment Officer of Assurance Wealth Management, it's just going to be me. So I'd like to do this one a little bit different than we typically do, where I'm interacting and asking questions with the other guest. I want you guys to be that other guest. So if you would, feel free at any point in time to put in the chat or the Q&A any questions that you have. Try to make this as interactive as possible. Makes it more fun for you guys, more informative for you guys. You get the questions answered that you're looking to get answered. And it's not as boring for me either, sitting here and just talking to a screen. So feel free to interact, ask as many questions whenever you want, and I'll try to answer them, in a timely manner. But I do want to get through a lot of information that we're going to go through here, because we do have a lot of people from all levels, from what we've seen on the registration, from beginner to advanced as far as trading. And so I'm going to try to cover kind of all of that. And because there's so much, there's so much content when it comes to investing and building portfolios that I can't fit it all into an hour. So I'm going to kind of touch on a little bit of all of it and answer your questions as we go. And so that way, whether you're a seasoned investor or you're just starting out on, your financial journey, we can try to provide you with some insights and strategies that you need to kind of navigate today's economic landscape. So we'll go ahead and get started. Let's see what kind of questions we have to start off before I dig in too much here. So Joey had a question about risk and using safe options. Joey, that's one of the first things we're going to talk about. So I will get into that here in just a second. I do want to have you guys keep in mind that I am a financial advisor. I am the owner of Assurance Wealth Management. And while I am a financial advisor, nothing I'm mentioning today is financial advice. Okay. This is all for education. This is all for you to learn maybe a nugget or two of information that you didn't know before, for you to get some questions answered. But for most of you, I am not your financial advisor. So take what I have here, use it as education, go in and learn, expand on it. If you have any questions, please feel free to reach out to us. But don't go out and just implement anything that we're talking about here today. Okay. This is all for education. So speak with a financial professional. You're more than welcome to come to us. As a matter of fact, if you see on your screen, you should have the ability to schedule a meeting with us. It should be up there now. Feel free to schedule a meeting if you have any questions that you want to get that are more on a personal level, and we would be happy to do that with you. So let's talk about some of the stuff that we're going to be going over today, which is, like I mentioned earlier, we're going to cover a range of topics that you need to understand. And the first one is the fundamentals of risk management. That's kind of a big topic because it's very important. We're going to talk about the 60-40 portfolio and the evolving relevance of it. There's a lot that kind of goes into that. And is it still relevant? Is it not? We'll kind of go into that a little bit. We'll discuss some traditional investments. We'll discuss the power of hedging, whether that be with options or using alternative investments. There's just kind of a lot there to go through. And my goal in this is to try to make these complex topics a little more accessible and engaging for you, and so you're not so intimidated by it, because investing doesn't have to be intimidating and it doesn't even have to be complex. With the right knowledge and tools, you can make informed decisions that align with your financial goals and your risk tolerance. I know just discussing financial strategies is not the most thrilling way to spend your time, But stick with me today. I'm going to go and try to keep this as informative and practical and maybe even a little entertaining if I can. Because after all, your financial future is important. And that's why we're all here, is we want to help you as much as possible. Got another question come in here. The election. Okay, Lawrence asked about the election and how that's going to affect portfolios. Quite a bit. So every election season, the market gets more and more volatile. We see that typically during election seasons that it kind of doesn't matter which side wins. It doesn't matter what your political stance is or what you think of the candidates. The market is driven by certainty and uncertainty by investors. And so with, the landscape of an election, there's a lot of things that are unknown. And so people don't like that, which is typically why the market you'll see be a lot more volatile during the next 6 months than it typically is. Does that mean it's going to shoot up if one candidate wins or another? Probably not. Does it mean that it's going to crash if the person that you want doesn't win? Probably not, but either could happen. Okay. So what we always look for, instead of guessing or assuming what's going to happen based off of politics, is we want to build a portfolio that can withstand it no matter which direction it goes, and that's built for a specific purpose and a specific return, a specific plan, and that's your financial plan. Okay, I think that's it for now. But again, feel free to guys ask questions as much as you'd like. Quick overview. Again, we're going to go into comprehensive risk management. And we're going to start with that because I believe it's kind of the backbone of any successful investment strategy is your risk management. You need to learn to protect your portfolio, both in good markets and in bad, but especially in volatile markets where it's swinging quite a bit in either direction. We'll go through the 60-40 portfolio, like I said, and we'll kind of explore how it came about, why it came about. Is it still relevant, or is it possible time for an upgrade? And I'll give you my personal opinions on it. We'll discuss some traditional investments, things like ETFs, mutual funds, stocks, and bonds, and how to balance them effectively. And then once you have that balanced portfolio, we'll discuss how effective hedging can be, whether you're using options or maybe some alternative investments, commodities, structured notes, things of that nature, that'll help just kind of diversify your portfolio. And don't forget, we're going to be, I say ending this with a Q&A session, but again, ask questions as they come up in your mind. Feel free. Let's make this as interactive as possible. So stick around. I think we've got a lot of good information for you, and we'll just go ahead and start diving into this. So we're living today kind of in a changing economic environment with inflation and interest rates. You've seen that run rampant all over the news. If you follow the market at all, you'll see all this market volatility. And those are just a few of the factors that can impact your investments. But, with the right strategies and a solid understanding of the market, hopefully you can navigate these challenges and achieve, whatever your financial goals are, whether that's retirement or anything else. As Warren Buffett, who you'll hear me quote quite a few times because the guy knows what he's doing, he once said that the best investment you can make in an investment is in yourself. Let me rephrase that. The best investment you can make is an investment in yourself. There we go. And the more you learn, the more you can earn. So let's see what we can learn. I went over the disclosures. I went over the fact that, again, don't take any of this and run with it. Please talk to a professional. Please, this is all for education today. So comprehensive risk management. That is our first topic. And again, you'll see me look down. There's a lot to unfold here. So I do have some talking points on my notes down below me that I will refer to from time to time because I want to make sure that you get all the information that we're looking to get across to you today. So risk management, what is it? What does it consist of? Do you need it? Well, I believe it's the cornerstone of smart investing. It's something that will balance out your portfolio. Whether the market's volatile, whether it's rising, whether it's falling, you want to make sure that your portfolio is built to withstand anything. So let's start with kind of, what it is. Risk management is your safety net, essentially. And, in the world of investing and market volatility, which we all face no matter you want to or not, it's kind of your safety net. So if you remember March of 2020, the S&P 500 dropped 34%-ish, somewhere around there, in just about 33 days. So imagine if you lost a third of your net worth or a third of the assets that you've saved for retirement in just a month. Well, if you didn't have any risk management strategies in place, that could have happened, and it would be disastrous for you, especially if you're retired or trying to retire soon. Now, again, Warren Buffett believes that the stock market is a device for transferring money from the impatient to the patient. So patience is a robust risk management strategy, because when you're going through volatile environments in the market, you need to not react with emotions. Typically people tend to, buy, as the market's going up and they see a hot stock and it's rising really quickly, and they'll buy it. And then you'll see that it'll turn around and fall on you because you followed the news. You followed, these different hot stock type investors, and you end up getting in, when it's already done, when that run is already over with, and then it turns around and starts crashing, or when the market in a whole starts crashing, people will start freaking out and sell out of their holdings because they don't want to lose any more. But unfortunately, the way that typically works is you end up selling out at the bottom, and you're going to miss the quick rise back up, and so you don't know when to get back in, which is why we always say guessing the market is a loser's game. Guessing when to get in, when to get out, guessing tops and guessing bottoms is just kind of a loser's game. So we want to make sure that you have a risk management strategy in place for your whole portfolio so that you can withstand a lot of that. So how do we protect our investments from kind of unexpected downturns? The two most common strategies: asset allocation and diversification. If you've been around in portfolios or the market, you've probably heard of both of these. Asset allocation involves kind of deciding how to distribute your investments among different asset categories. For example, one thing we'll talk about a little bit more later, a balanced portfolio that is 60-40. This typically consists of 60% equities, 30% fixed income, and 10% in cash or some sort of cash alternative. It's important to regularly revisit and adjust this asset allocation based on the market conditions, your personal circumstances, and you can also diversify within each one of those asset classes. So diversification just means spreading your investments across various asset classes like stocks, bonds, real estate, commodities, so on and so forth. This way, if one asset class underperforms, your overall portfolio remains stable. Famous investor John Templeton once said that the only investor who shouldn't diversify are those that are 100% right 100% of the time. It's not me. It's not you. It's not any professional investor. Nobody's right 100% of the time. So unless you have that crystal ball, diversification is always going to be a good bet for your defense. So here's how you can achieve some of that effective diversification across asset classes. Let's spread your investments across stocks, bonds, and maybe some alternatives like real estate, commodities, cash. And then also within asset classes, diversifying each asset class. So we're looking at stocks. You want to invest in various sectors, from geographic regions, tech or oil and gas. I mean, there's a bunch of different ways of doing that, but just getting diversified across different sectors, also geographically. When it comes to bonds, varying in maturities and credit qualities is a way to do it. You reduce the impact of any single asset's poor performance, on your overall portfolio that way. Now, as I mentioned before, here at Assurance Wealth Management, we believe in kind of tailoring your risk management plans. So when coming up with a proper risk management strategy, we want to not just account for your comfort level, but also what your specific plan requires to meet those financial goals. There's a balance between needs and wants here. So if you build out a plan that calls for 6% rate of return on average, but you're so conservative that you can't achieve that, we're going to have to work with you to figure out a balance that will both make you comfortable and keep your plan on track to meet all your goals. These tailored plans are fit to your unique profile, ensuring that your risk management strategy fits your specific needs. So to kind of wrap up the risk management side of things, it's all about just avoiding some risk. You're not going to avoid risk altogether, but you need to be prepared. It's about knowing your strategy, diversifying your portfolio, and kind of maintaining a balance there. Again, Warren Buffett, sorry about that. I keep hitting the microphone here, but risk comes from not knowing what you're doing. One of the most traditional ways of investing was designed for growth, and it's something we talked about with the risk management, is the 60-40 model, which I'm sure many of you heard of. If you're not working with me, then you probably have a 60-40 model or something, close to it, because it's a very common thing for people to be invested in. So the question becomes, is it right for you? Is it outdated? Is it still viable? Is the 60-40 portfolio, as some people say, dead? Well, let's break it down and kind of figure out and see if that traditional strategy has a place in today's modern investing. First thing I'm going to do is take a trip down kind of memory lane here. The 60-40 portfolio, which is traditionally 60% stock, 40% bond, or some sort of safe fixed income there, has been a kind of a cornerstone of investment strategies and taught to everybody across the world for decades. It was designed to balance risk and reward, providing growth through stocks and stability through the bonds. Now, this model worked well in the past, especially during periods of high interest rates and steady economic growth. But I think we all know times have changed, and we're dealing with a very different economic landscape today. Interest rates had been low for a very long time. They are a little bit higher now, but we also see inflation creeping up. The kind of main concern a lot of you had, according to what you told me, is high market volatility, in which unfortunately is just kind of the new norm these days. These factors significantly impact the effectiveness of the 60-40 model from a risk management standpoint. The lower interest rates mean that bonds are offering lower returns, and increased inflation will actually erode the bonds themselves, so the price of the bonds. So with increasing interest rates with lower interest rates and increasing inflation, bonds, it's just making it harder for the bond portion of the portfolio to provide the necessary stability that you've always looked for in the past. So is the 60-40 model still viable? Is it right for you? Well, let's kind of look at both sides of that argument. So arguments for the 60-40 model would be simplicity and that it's time tested. The 60-40 portfolio is simple and has historically provided decent returns with moderate risk. Well, stability, in today's environment, bonds can still offer some level of it, and you still will get diversification against the stock market. But it may or may not be the best for you. It's something you need to learn about, look into, and see if it's right for you. Because some of the arguments against it are, again, the lower bond yields, and when they're low, the income portion of your portfolio isn't pulling its weight. Inflation's obviously an issue. Rising inflation further diminish the bond returns. And when you're looking at the 60% or the equity part of it, that market volatility that we've got today, it can be extremely volatile, which may require a more kind of dynamic approach to your risk management. I'm going to quote one more very smart individual, Benjamin Graham here, who once said that the essence of investment management is the management of risk, not the management of returns. Also have another quote from a very smart man who I learned most of what I do from, my father, who likes to tell people that it's not a matter of how much you make, it's a matter of how much you keep. And what he means by that is, in the good markets, when the market's going up, everybody makes money. It's not hard. You can be invested in almost anything in the good markets and you're going to make money. It's not about that. It's about the years that it's bad and the market's going down. How much of it can you keep so that way you can get back to even and start making money faster? So in today's market, managing risk might mean looking beyond that traditional 60-40 split. So personal take on this. I think the 60 portfolio model is not dead. I just think it needs to be upgraded. Kind of think of it like a cell phone. So the idea of having a cell phone is not dead, right? Everybody's got one. You all need them for everything that we do. but they need to be updated. The software needs to be updated. The type of phone you have needs to be updated based off of your use. And so keeping your portfolio updated and changing times, I think it's necessary. So how do we modernize the 60/40? I think it's to incorporate kind of alternative investments, adding assets like real estate, commodities, structured notes, maybe even cryptocurrencies for some people. That'll enhance your diversification and potentially boost your returns as well. Now, we can look at dynamic asset allocation, which is being more flexible with your assets and adjusting your allocation based off of market conditions and personal circumstances rather than just sticking to a very rigid 60/40 split all the time. The other way that you could enhance this is by using hedging strategies. The use of options or other hedging techniques to manage your risk and protect against market downturns could be a very viable option. I will say when it comes to options, though, and I keep saying the word options, when it comes to investment options, you need to make sure that you do your homework and know what you're doing. Options are a great way to hedge your overall portfolio, but if you don't know what you're doing, you are leveraging, you can lose a lot of money. So that's my kind of disclaimer there on options. Remember, investing is not a one size fits all game. It's about finding what works for you in your unique situation and being willing to adapt and as the market evolves. So kind of to sum up that whole 60/40 talk, I think it served well for investors for many, many years. But today's economic environment with social media and how fast the news travels and how volatile the market is, I think it calls for a more dynamic approach. It's about balancing tradition with innovation to achieve the best outcomes for your situation. Now let's get into some more kind of discussion on the traditional investments, and then we'll follow up with the not so traditional strategies that can boost your portfolio. So what are traditional investments? We're talking ETFs, exchange traded funds. We're talking mutual funds. We're talking stocks, and we're talking bonds. What are they? What do they do? How do you use them? Well, these investment vehicles are kind of the bedrock of any portfolio, and understanding how to use them effectively can make a big difference in your financial success. So let's break it down a little. First, we'll talk about stocks and bonds, the most traditional asset classes out there. These are the building blocks of most investment portfolios. And when you buy a stock, you're kind of buying a piece of the company. You're buying ownership in that company. Stocks have the potential for great returns. We've seen that in many years. And, if you've been following companies like Apple or Tesla, you see these big runs that they go on. But with that comes higher risk. So the key to successful stock investing, in my opinion, is going to be diversification and picking stocks with strong fundamentals that may or may not correlate to one another. You don't want to put all your eggs in one basket. So you can diversify your stock holdings across different sectors like tech or healthcare or finance, and again, across different geographies, both domestic and international. That'll spread out your risk and help you get more consistent returns. For example, when the tech stocks have boomed in recent years, having exposure to other sectors can help balance out your portfolio for the years that tech does not do so well. I think the prime example of this is if you guys watch Tesla's stock prices. They will skyrocket and then they will plummet, and then they will skyrocket and then they will plummet. We want to even out that roller coaster by diversification. So what are bonds? Bonds are essentially loans that you give to the government or a corporation in exchange for periodic interest payments that will return the principal at maturity if you hold it that long. They're generally considered safer than stocks and provide a steady income stream, making them kind of an essential part of the balanced portfolio, typically. In today's, kind of lower interest rate environments, though, bonds yields are fairly minimal, which makes it a challenge to rely solely on bonds for income. However, they can still play kind of a critical role in providing stability and reducing overall portfolio volatility. We kind of talked about that a little. But again, getting the right kinds of bonds does matter. So balancing out stocks and bonds in your portfolio kind of depends on your risk tolerance. It also kind of depends on your investment goals and your time horizon. So a younger investor with a long-term time horizon might favor more stocks and growth potential because they can ride that roller coaster of ups and downs. While People that are about to retire or retirees might prioritize, bonds or some sort of income and stability in their portfolio. Another strategy that we haven't really discussed just yet is sector rotation, which kind of involves shifting your investments into sectors that are expected to outperform the current economic cycle. This can enhance returns and manage risk, and it focuses on companies with strong financials, ones that have competitive advantages and good growth prospects. Again, I will kind of put the disclosure in here that if you're going to try sector rotation, you need to know what you're doing. You need to read up on it. You need to understand the cycles of the market, because again, you are, for lack of a better term, guessing what's going to go on in the market, and that may or may not work out for a lot of people. So, let's think of what Warren Buffett, one of the most successful investors in the world, and who I've quoted multiple times already. He advises looking for companies with a bit of I think he calls it a moat. So a sustainable competitive advantage that kind of protects them from all of their competitors. So what are ETFs and mutual funds? Well, these are very similar to stocks and bonds, but they're popular choices for investors that are looking to diversify without having to pick individual stocks and bonds. ETFs, or exchange traded funds, are just a basket of stocks or bonds or combination that can buy and sell on an exchange, kind of like you do a stock. So you can buy the ETF just on the exchange like you do a stock, but they offer diversification and flexibility with typically lower fees than a mutual fund by creating that basket of stocks inside of that. So that's how you're getting your diversification. So one ETF may hold 3, 4, 5, 600 holdings inside of it, and you only have to buy the one ETF. That's how you're getting diversification there. So if you want exposure to the entire S&P 500, you buy an ETF on the S&P 500, and now you've got exposure to the entire thing without owning all 500 stocks. So mutual funds, on the other hand, kind of pull money from many investors to buy the same type of diversified stock or bond portfolio, or some other securities sometimes. And they're managed by professional fund managers that can be a great way of access professional management. However, they do come at typically a higher fee and are only traded at the end of the trading day. So how do you choose between ETFs and mutual funds? Kind of depends on your investment goals, how much control you want, your sensitivity to fees comes into play here. And I've had many of my clients and have heard of many professionals talk about making sure that you have the lowest fees possible in your investments, because they eat away at your returns. This can be true. But on the other hand, I've also had clients and plenty of professionals discuss that the only important number is your net return. So some are willing to pay a little bit higher fees for more returns. I actually had a client one time tell me that I don't care if you invest in shoelaces or umbrellas or oil companies. You can charge me 1% or 5%. As long as my net returns are where they need to be, the rest is just noise. So while that isn't applicable to everybody, that is just food for thought there, that what's important to you, is it the end result, the net fee or the net returns, or is it kind of the path to get to those? So ETFs offer much more flexibility and that lower cost, while mutual funds provide professional management and a more hands-off approach for you. So in today's market, we're seeing a kind of a growing preference for ETFs due to their cost effectiveness, and again, all the fee discussions out there. And it's kind of the rise of passive investing, where according to, I think it was Morningstar, passive funds, including ETFs, accounted for roughly 45% of the US fund market in 2021. So it's up to you when it comes to ETFs and mutual funds, but I definitely get educated on them and learn what's inside of each one of them, as well as the fees that they're charging and how often they're trading, kind of what the strategy is behind them. So to wrap up, the ETFs and mutual funds, they offer easy diversification and can be tailored to kind of your investment style. Stocks provide growth potential, while bonds are designed to offer stability and income. Balancing out all these traditional investments has long time kind of been the basis of many portfolios. So how do we enhance these? How do we bring these up to modern day, like I talked about earlier? Are there ways to increase the growth potential of these standard portfolios? Are there ways to decrease the risk? Well, let's talk about it. And we'll talk about one of the options, pun intended there, for enhancing your portfolio. And what that is diving into the world of what's called options. And today we'll focus, how they can be used for hedging for investments. And they are pretty complex if you want them to be. So again, before anybody goes off and starts using options, please, please, please talk to a financial professional or go and do your homework. Do not take what I'm saying here today and run with it, because they are complex and they can provide they can be kind of a powerful tool for managing risk and enhancing your investment strategy. It's just, you got to know what you're doing. So let's get a grasp on the basics first. Options are kind of financial instruments that give you the right, but not the obligation. So the option to buy or sell an asset at a predetermined price at a predetermined date. Okay, so you have the option, you have the right, but not the requirement to buy an asset at a predetermined price at a predetermined date. So how do we use these, or what are some of the strategies around these? There are options. There's options called calls, and there's options that are called puts. A call option gives you the right to buy an asset at a set price. Think of it as a way to lock in a purchase price if you believe that that asset's value is going to go up. A put option gives you the right to sell an asset at a set price. This is useful if you think the asset's value will drop and you want to secure a selling price. Options can be a bit like insurance for your portfolio. They can protect your investments from unexpected downturns or allow you to profit from anticipated price movements upwards without fully committing to buying or selling the underlying asset. So let's talk about how options can be used for hedging. We talked about that a little earlier. You build your portfolio of stocks and bonds or ETFs and mutual funds or a combination of all four. How do you use these options to hedge? Well, hedging is all about reducing risk, and options can provide a strategic way to do that. One of the most common strategies is what's called a protective put. So imagine you own a stock that has performed well, but you're worried about potential decline. You can buy a put option on that stock, which gives you the right to sell it at a set price. If that stock price comes dropping, that put option increases in value, offsetting some of those losses. Another strategy is what's called a covered call. If you own a stock again and think its price will stay relatively stable, maybe rise up a little bit, you can sell a call option on that specific asset or stock or whatever it may be. You'll receive a premium for selling the call. And if the stock's price stays below your strike price where you sold that call, you get to keep the premium. And it's just an extra source of income for you. If the stock price rises above the strike price, you'll end up selling the stock at the agreed upon price on the agreed upon date. So you're potentially giving up some of the upside, but still profiting overall. Let's look at kind of a real world example here. During periods of market uncertainty, such as geopolitical events, what we have going on now, or an earnings season, investors often use options to hedge against potential volatility. For instance, during the 2020 pandemic, if you had purchased put options, you could have possibly offset a lot of your losses during that quick crash. Using options effectively requires understanding the costs and the risks involved, which is why I keep telling you, please go and do your homework or get with a financial professional before you make any moves with options. Let's see here. We got a question come in, so I'll just stop for just a moment because I want to, again, be interactive here. So given somebody's ultra-conservative investment style, they're asking what strategies or asset classes I recommend to ensure capital preservation while still kind of aiming for some growth. How will you adjust this approach if my risk tolerance or financial situations change? Okay. So essentially what he's asking about is what if you're in one situation today and you're ultra conservative, so you still want some sort of growth as everybody does to maybe outpace inflation. And you don't want to take the risks of the volatile market, but down the road, your risk tolerance may change, or you might have a different circumstance. Well, I can't answer that question as far as what I recommend you go do because I'm not your financial advisor. But what I would say is make sure that your investments, as far as your portfolio are concerned, are more weighted if you're going with the 60-40 type model, traditional investments, more towards the bond cash alternative side of things. So you'd be looking at fixed income ETFs. You'd be looking at fixed income mutual funds. You'd be looking at buying individual bonds. A kind of strong strategy for this would be bond ladders. And what that is you're buying bonds that have different expiration dates or maturity dates. And so you might have a 1, 2, 3, 4, 5 year bond ladder. And as they mature, you go to another 5 years. So you're just kind of rotating them, and that'll create a nice steady income for you for the ultra conservative. And it also has to do with a couple other things with your situation as far as what I recommend you going out and buying a bond ladder. I don't know. There might be some other things in your situation or what you're targeting to decide if that makes sense or not. Okay, so as far as your risk tolerance changes, if you're in traditional portfolios, as long as you're not in something that's going to lock you in for years and years and years on end, which ETFs don't, which mutual funds don't, stocks, bonds don't, options, you get to pick what day you get in and out of them. You can always change your portfolio. And so if your situation changes, maybe you can adjust from having 70% in bonds to 40% in bonds or whatever it may be. Again, that's kind of from a traditional sense, without knowing your specific risk tolerance, without knowing your specific comfort level with things like alternative investments, what we'll get into in a second. It's hard for me to recommend you doing anything other than kind of traditional investing. So back to the options side of things is, using options again can be effective, and it effectively requires you understanding kind of what's going on and the costs, the risks. Let me see where I was on my notes here. But it's not for everyone. Options are not for everyone, but with kind of the right knowledge of options, they can be a valuable addition to any risk management toolkit. If you'd like to know kind of a good source of information about how to use options, reach out, shoot me an email. I've got a great source that you can go and learn everything you want to learn about options. It's a great place. It's free. It's just a website that you can go to and get a lot of education so that you can go and educate yourself on options. Now, while options can be a very powerful tool, they're not without risk. I've mentioned that multiple times already, but it's essential to be aware of these before diving in. So one of the risks of options is the premium costs. When you buy an option, you pay a premium. The cost can add up, and especially if the options expire worthless, it's similar to paying for insurance premiums and not using the insurance. Okay, so the money is spent without any sort of direct benefit. They're also fairly complex, and strategies around options can be even more complex and require a great understanding of the market dynamics and specific terms of the options that you're using. Misunderstanding these can lead to unexpected losses and kind of limited usefulness. In some market conditions, options may not provide the protection or the leverage that you're seeking anyway. It's important to have a clear strategy and be prepared for the different scenarios. As many investment tools, it's crucial to do your homework. And if necessary, consult with a financial advisor to ensure options are used appropriately within your overall investment strategy. So to kind of sum up options and how versatile and powerful of a tool they can be for hedging, there are risks. So please, by understanding the basics and knowing how to use strategies like protective puts and calls, you can manage risk more effectively. However, always be mindful of the costs and complexities that are involved. The next portfolio enhancement, if you will, we'll look at some of the alternative investments and where they fit in. These are investment options kind of beyond traditional stocks and bonds, mutual funds, and they can play kind of a crucial role in diversifying and strengthening your portfolio. The first thing I want to talk about, which my clients are very familiar with, is called structured notes. These are customized investment products created by financial institutions, and they combine elements of bonds and derivatives to offer a unique risk-return profile. I believe the best way to explain these is kind of through some examples. So imagine you're a conservative investor This may go along with Lawrence's question here a second ago about being ultra conservative. Again, without knowing your situation, how comfortable you would be with these, I'm not sure if they're right for you, but Lawrence, this may be an option. As a conservative investor who wants exposure to the market, wants to grow, but is concerned about potential downside risks. If you're looking for an investment that provides some growth potential, but will also protect your principal, this is where structured notes kind of come into play. So the scenario is you decide to invest in a structured note linked to the performance of the S&P 500. The note has a 3-year maturity and offers the following terms. Principal protection of 100%, meaning that no matter what happens, you will get your principal back when this matures. So you invest $100,000 on maturity date, you get $100,000 back. Okay. Now, regardless of how the S&P 500 performs, your capital is protected. But this comes with a capped upside participation. So if the S&P 500 increases over the 3-year period, the structured note will also provide a return equal to maybe 80% of the index's gain, up to a maximum of 20%. So if the S&P 500 rises by 25%, you're going to be capped at 20%. And if the S&P rises by 15, you might get 12, which is 80% of the 15. Now, that downside protection is if the S&P declines, you still receive your initial investment back, meaning your downside risk is limited to the opportunity cost of not earning a return during that investment period. So let's look at a few possible outcomes here for that specific scenario. If the S&P increases by 30% over 3 years, you will get 20 by providing, a substantial gain while protecting your initial investment. It's kind of a give and take there. So what if there's moderate performance, like the S&P increases by 10%? Again, you in this scenario will get 80% of that, so you will get an 8% return, which is still a positive outcome with principal protection. Now, in a negative market, when the S&P drops 20 or 30%, you will not earn a return, but you will receive 100% of your principal back, preserving your capital in a down market. So what are the benefits of the structured note? Is, well, in this case, capital protection, and ensures that you do not lose your initial investment, and you do have potential for growth, and allows participation in the upside of the market, albeit with a cap, and customized kind of risk-reward portfolio. You can tailor these to fit your risk tolerance as well as your investment goals. So what are the risks to these? Well, in this particular case, maybe limited upside is what you see as a risk. And that'll cap your returns, which means you won't fully benefit from strong market performance. Now, the structured notes are able to be built in many, many different ways. So complexity might be a risk or an issue for you. Structured notes can be kind of complex if you want them to be, which would require an understanding of the specific terms and conditions. And then the last risk here is credit risk. So the return of your principal and any gains are dependent on the issuer's credit worthiness. So real life application is, consider you're nearing retirement and you're looking to preserve your nest egg while still seeking some growth. A structured note with this 100% principal protection and a capped upside may offer some balanced approach for you. It provides exposure to the stock market and potential gains while safeguarding your principal against market downturns. This way you can achieve a degree of growth without taking any significant risk. So to kind of put a cap on the structured notes is they can be built in many, many different ways. I gave you one example. They can be built with leveraged upside. They can be built with more downside protection. They can be built where you have gains in both directions, no matter what the market does. So there's a lot that go into structured notes that it would be something that I would say sit down with a specialist that uses structured notes on a regular basis to figure out if they're right for you. And as my clients know, we do have a lot of structured notes, so feel free to give me a call if you have any questions on them. I'd be happy to go through them with you. Neil, I do see your comment there about getting the options education. I'll send that over to you as soon as we get done. No problem. The next type of alternative investment would be a real estate investment trust or a REIT. REIT companies Well, REITs are companies that own and operate or finance income-producing real estate. So they offer a way to invest in real estate without having to directly own the brick and mortar or manage the properties. The benefits of this is diversification. The REITs allow you to invest in a variety of different property types, such as commercial buildings or apartments or shopping centers, and they generate income. REITs typically pay out a regular dividend, providing a steady stream of income. Liquidity. So unlike direct real estate investments, REITs are traded on the open market, so offering a lot better liquidity as you can get out of them when you want versus owning a building and then having to find a seller or a buyer and all that kind of stuff. What risks come along with REITs? Well, market sensitivity is one of them. I mean, just like any other real estate. So REITs can be affected by the changes in the real estate market, interest rates, the same things that affect real estate will affect the REIT. What about management risk? Well, the performance of the REIT is dependent on the management company and the management's ability to select and manage properties effectively. So real life application of this would be consider investing in a REIT that focuses on commercial properties, such as office buildings, shopping centers. During an economic boom, the demand for office space and retail locations increases, driving up the rental income, driving up the property value. And as REIT investors, you get to benefit from the steady dividends generated by the rental income, as well as potential for capital appreciation as the value of the property increases. In this way, REITs provide a way to participate in real estate market growth without actually having to manage or own the brick and mortar. You don't have to put as much capital up. So think of it like buying an ETF that is holding all real estate inside of it. You don't have to buy a $500,000 property. You can invest $100 into that REIT, and now you get a portion of that property without owning the whole thing. You also have more liquidity and the added benefit of professional management. If you are not used to managing, real estate on your own, you've got professionals that are managing that for you. The next type of alternative investment would be private equities. So private equities involve investing in a private company that are not listed on public exchanges. These investments are typically made through private equity firms that pool funds from investors to buy and manage these companies. Some of the benefits are potentially very high returns. Private equity investments can offer higher returns than a lot of other types of investments, especially if the companies grow significantly or significantly sold for profit. They also have active management. So private equity firms often take an active role in managing and improving the companies they invest in. Some of the risks that come along with private equities would be illiquidity. So typically, these investments are not easily sold or traded, and investors may have to wait several years to see any sort of returns. They also typically have a high minimum investment. These investments usually require substantial minimum investment, making them a little less accessible to most individual investors. Real life application of this is, imagine you invest in a private equity fund that focuses on early stage tech startups. The fund identifies a promising startup with a groundbreaking software product. By investing in the startup, the private equity provides capital for growth and takes an active role in guiding the company's development. Over several years, the startup grows significantly, gaining market share and increasing in revenue, and eventually the company goes public or is acquired by a larger corporation. This results in substantial return on investment for the private equity fund. As an investor in the fund, you get to reap the rewards of successful exit, which can be significantly higher than the returns you get from traditional investments. Now, this example illustrates how private equities can offer high returns and the chance to be a part of the growth, of innovative companies. But, it takes patience and it takes tolerance for illiquidity and kind of a much higher risk. And then the next alternative investment we're going to go through is commodities, or raw materials, or primary agriculture products that can be bought and sold. So when you think commodities, you're thinking of things such as gold, oil, wheat, things of that nature. So investing in commodities can be done through what's called futures contracts. Commodity-focused mutual funds, or ETFs, are out there. And the benefits of commodities are being an inflation hedge. So Commodities often perform well during periods of high inflation, providing a hedge against rising prices. So they also help with quite a bit of diversification, including commodities into your portfolios can help diversify your investment mix, kind of reducing your overall risk because they're not real correlated with a lot of the other investments. Risks of commodities would be volatility, just like almost anything else. Commodity prices can be highly volatile and influenced by factors such as weather, geopolitical events, supply and demand, and there's no income generation with these. Unlike stocks or bonds, commodities don't generate an income, relying solely on the price appreciation for returns. A real-life application would be you are concerned about the rising inflation eroding the value of your investments. You decide to allocate a portion of your portfolio to commodities, we'll say specifically gold. Historically, gold is seen a safe haven of assets that retain its value during times of inflation and economic instability. And during an economic downturn, when inflation rates rise and currency values fluctuate, the price of gold often increases. By holding gold in your portfolio, you protect your overall investment value from the negative effects on inflation. Additionally, as demand for gold rises in uncertain times, your investment appreciates, providing a counterbalance to the declining assets in your portfolio. Investing in commodities like gold can provide a tangible asset that acts as an inflation hedge and adds diversification, helping to stabilize your portfolio during market volatility. The one thing I will say about precious metals like gold, silver, is be careful where you buy them. I know that you see it all over the TV about buying gold and the end of the world and all that kind of stuff. A lot of those companies have specific terms on their gold where you're buying the actual gold and they hold it in their safe or storage facility somewhere. But they can be very hard to get out of, for one. And then also the fees and the terms that are inside of those make it almost impossible to make money with that metal. So I just say be careful where you get those and make sure you do your homework. Again, don't just go to the first person that tells you to buy gold and buy gold from them. Do your homework, do your due diligence on it, because they do have some terms inside of those that I've seen definitely hinder and hurt a lot of investors. So to sum up alternative investments, they offer kind of an exciting opportunity to diversify and enhance your portfolio, whether it's through structured notes or REITs or private equities or commodities. These tools can help you navigate the ever-changing market. But again, you need to know what you're doing. You gotta do your homework on them. So we've covered a lot. We've covered a lot of ground today. And I know I was talking fast because we've only got about 8 minutes left. So you see, I try to squeeze all this into the hour that I promised you. But we've talked about the essentials of risk management to the evolving relevance of the 60-40 portfolio, kind of the foundational principles of traditional investing, talked about possibilities offered by alternative investments, as well as stock options and hedging. So to kind of quickly recap the takeaways from today, risk management, in my opinion, is essential for navigating market volatility, and diversification and asset allocation are kind of your traditional tools that you need to tailor your risk and your risk management strategy to fit your unique profile. So whatever you do, whether you are 30 or 70, risk management is something that you need to think about within your portfolio and make sure that you are actively implementing that in your portfolio. We talked about the 60-40 portfolio and how historically effective it was, but I believe that it needs to be modernized in today's low interest rate, high volatile environments. Consider incorporating alternative investments and dynamic asset allocation. Traditional investments like ETFs, mutual funds, they offer the easy diversification and professional management. But consider some other options for that 60-40 portfolio. So again, we talked about the alternatives. One couple things we didn't talk about is life insurance and how it can be used. We didn't talk about annuities and where they fit in for some people. We didn't talk about some other investment products that are out there. Again, trying to squeeze everything within an hour, but look at some of the other options out there and don't just trust that, you may have a financial advisor right now who's got you in some sort of 60-40, 70-30, 50-50, whatever it may be. it's a mix of stocks and bonds or ETFs and mutual funds, and they just, rebalance it once a quarter, once every 6 months. That doesn't necessarily mean it's right for you. Okay, that's the easy way to invest. Sure, but that's something you can do on your own. So I would say, make sure that you know what you're invested in and why you're invested in it. Okay, so a little food for thought there. Now, well, we talked about the stocks and the bonds and how they can, balance one another, and how bonds offer stability and income and balancing out the investment risks of the stocks. We also talked about hedging with options. Now, I can't stress this enough with the options. Educate yourself. Whether you're interested in them or if you're interested in them, educate yourself. They can be complex. They can be very dangerous if used the wrong way. But they can also be very effective and very helpful if used the correct way. So options can protect your portfolio from market downturns. Strategies like protective puts and covered calls, which we covered, can manage risk effectively if you know what you're doing. So the alternative investments that we talked about were structured notes, REITs, we talked about commodities, and private equities. And they're all there to enhance your diversification, enhance your returns, add some more protection. But again, like the options, be aware of the complexities and the risks that are involved inside each one of those. So my final thoughts for investing in today's, economic environment, I think it involves a requirement, a blend of traditional wisdom and also an innovative strategy. So modernizing your old portfolio. It's about balancing risk and reward and staying informed and being adaptable to the market changes. The market changes, so should you, and so should your portfolio. And one more final Warren Buffett quote for you. In the business world, the rearview mirror is always clearer than the windshield. In the business world, the rearview mirror is always clearer than the windshield. So as we look ahead, remember that having a clear strategy and diversified portfolio can help you navigate whatever lies on the road ahead. But you are trying to get educated and put the best portfolio in place that you can. Looking in the rearview mirror and saying we should have done this is easy. Everybody's vision is 2020 looking backwards. Okay, so just make sure that you are prepared for what's ahead, and then as it comes, do not get emotional with your investing. Okay, that is the number one killer, in my opinion, of portfolios is emotions. If you have any more questions or need any personalized advice, please, again, don't hesitate to reach out. Don't hesitate to schedule a meeting with us. My team here at Assurance Wealth Management we're here to help you. We're here to help you achieve your financial goals. And we do that through education, through confidence, through clarity. So for those of you not staying around for the Q&A and don't have any questions, again, I want to thank you for tuning in. It's been a pleasure guiding you through this in today's topic. I understand we went through a lot in a very short period of time, and I just kind of lightly touched on a lot of different topics. We do hold these every single month, and every month it's on a different topic. Next month is Life Insurance Awareness Month, so we will be bringing in a specialist to talk about life insurance and not just your typical term policy. Okay. We're going to be talking about more in-depth topics when it comes to life insurance, who needs it, why you might need it, different strategies for using life insurance. And I think it'll be a great presentation. Until next time, keep your investment strategy sharp, stay diversified, always be prepared for what's next in the market. And again, thank you everybody for coming today. I will be here for another 10 to 15 minutes answering any questions that you guys have. So start firing away. Let's see what you guys got, and I'll do what I can to answer it. If I don't get to your question today, I will reach out to you after this and answer it personally for you. So thank you again for coming, and ask away on the questions. Got another question about the options. Yes, I can send you that information about the options and the website that you need to go to. It's a great website. A lot of videos, a lot of educational content in there. So it's a great website for options. But again, I can't stress enough when it comes to options or any of the alternative investments. Please, please, please educate yourself. Joey, as we get older, should we move towards safer options? I'm feeling my risk isn't what it used to be. Yeah. Yes, absolutely. I mean, so as long as you have built into your strategy a level of risk management that fits your overall plan, you're fine. Now, if you want to continue to reduce it and you're going to be wanting to, I don't know, pull completely out of the market and get into CDs and savings accounts and that kind of thing, I will say there's risk that comes along with that as well. And what that risk is inflation risk. So if you're in CDs, or savings accounts that are offering 3, 4, even 5%, just remember that inflation is going to eat away at that. So you need to make sure that whatever you're getting into is that it's going to keep up with your plan. Can you describe your investment process, how it differentiates from other advisors? Specifically, how do you incorporate research, risk management, client goals into your strategy? Great question. Great question. So our investment process doesn't start until after we have a either financial or retirement plan in place for you. So the first step that we take with everybody is to go through and figure out what your financial plan is, what your goals are, what you're trying to achieve, what you want those portfolios to achieve. Because in my opinion, if you're a financial advisor that brings a client in and just throws them in one of your 5 or 10 portfolios and then you rebalance it, what good does that do anybody? We are trying to create portfolios specifically designed for you and for your goals and for your plan. So everybody's different. Everybody's at a different stage in life. Everybody's got different goals. So when somebody comes in and we figure out, here's their goals, here's their longevity, here's their risk tolerance, okay? We take all this into consideration and we're able to figure out, John, you need a 6% rate of return annually on average to achieve all your goals, okay? So then we build out the portfolio to try to get to that level, and we want to do it in a way that you are comfortable with. As they say, there's more than one way to skin a cat. So whether that be stocks and bonds and mutual funds, ETFs, whether that be structured notes, annuities, life insurance, private equities, REITs, whatever it is, I don't really care what the holdings are. I got to get you in a portfolio that accomplishes your goals and that you are comfortable with. So once we have all that in place, then it's a constant monitoring and things may change. So in the economic environment as we are in right now with the election going on and we're in the election season, all of my clients got an email from me, was it early June, that said, hey, election season's coming up. We have some good gains in a lot of our portfolios. We need to go ahead and capitalize. Basically, what we did with a lot of our clients was we sold out of a lot of their positions to capture those gains. And then we got them in hedged portfolios and or structured notes that would now protect their downside during this volatile time period in the year. So that's kind of how we look at things, is creating the strategy first, then creating your portfolio for your strategy, because we believe your portfolio needs to be invested for a reason, not just a random pick of stocks and bonds or ETFs. So it needs to be invested for a specific purpose. So once we have that, then it's a matter of monitoring the market and what's going on in our environment and adjusting for that, also adjusting for changes in your life. Any perspective on the historic performance of REITs and expectations for the near future? Well, yes and no. So a lot of it depends on, in my opinion, the economic environment for real estate in general. So if you're comfortable and familiar with real estate and the markets in the real estate area, then we could definitely have the discussion about getting into REITs and what that looks like and the historical performance of it. I will be the first to admit to you, I am not an expert when it comes to real estate. That is not, my bread and butter there. So for my personal opinion on this, I don't have one and I don't have an outlook for the near future. But because of that, one of the things that we do here at Assurance is that we have a team of partners. So we've got a lot of individuals that we work with that are specialists in a lot of different areas. I would be more than happy to reach out to one of our specialists in the real estate market and figure out from them what their outlook is, what they think is going on. And we typically have a couple of specialists in each area. So I'd have no problem reaching out to those people, getting some kind of pulling together some opinions that they have and getting back to you on that answer. I just personally don't have my foot in a lot of the real estate world. So I don't unfortunately have a specific answer for you, but I can get you one. Not a question. I just wanted to let you know I have an advisor I work with, and he has never done any of this. Thank you for the great information. Well, thank you. Thank you for coming. And if you're interested in anything that we talked about again today, or just want to see if it fits you, feel free to schedule a call. And 15, 20-minute phone conversations never going to hurt anybody. You can only get more informed. So I'd be happy to have that call with you, answer any questions for you, figure out what it is that you're looking for, and see if there's anything that we can do to help, and see if it's a good fit. Thank you for doing these. You're welcome. Thank you guys for coming. I mean, that's why we do them, is try to educate people as much as we can. So we're here to help. If you have any questions, let us know. It doesn't look like we have anything else. I want to thank you guys again one more time for coming. Always enjoy doing these. Always enjoy hearing the questions, and hopefully getting some education across to you guys that would be helpful for you in your financial journey. So if there's nothing else, I'm going to go ahead and end this now. Again, if you think of something comes up, please feel free to reach out to myself or anybody on the team with any questions that you have, and we'll be happy to get you those answers. Other than that, thank you again for coming, and I look forward to seeing you guys next month.